All right, let's have a chat about asymmetry. I just watched a video with Peter Brandt and Raoul talking about asymmetry and just the market evaluations, all kinds of stuff. So this is Brian Lewis with MMT Investing, and things just changed. So asymmetry, if you watch the George Gammon channel, he loves to talk about asymmetry. George Gammon says if you go and you get an investment at a at an inflation adjusted mean reverted bottom, then the odds of it going down are tiny and the odds of it going up are very high. And that's an asymmetrical investment where the upside is just way, way bigger than the downside. And he likes to look for like a 90% asymmetrical investment if he can, as a really good long-term value investment. And I was just listening to Peter Brandt and Raoul kind of talking about asymmetry in the opposite way. And it's sort of an inverse asymmetry idea where now, instead of a mean reverted inflation adjusted bottom, we're really at a mean reverted inflation adjusted all time top here at the top of the everything bubble. And they weren't saying that things are definitely going to go down or anything like that. They're just saying that it looks like the upward movement from here would be kind of small, and the possible downward movement from here would be large. And they didn't say 90%, but that general idea of an asymmetrical investment where the direction against is tiny and the direction with is down. But how do you do an asymmetrical investment if you're at the top? You can't buy a negative stock, right? So there's the ideas of, I guess, shorting the market. There's some inverse funds that are interesting. And then Peter Brandt just said he has no stocks. He sold everything. He's completely out of stocks now. And he just said that it just looks like right now at these valuations and with this market moves that we have just seen, it just looks like the odds of going down now are so much greater than the odds of going up now that anybody that wants to give him cash for his stocks at these recordly high valuations, he's happy to take the cash. And that's what he just did. He just sold all of his stocks. And they're talking about, gold and Bitcoin and treasuries and what kind of things you can hold during these periods. And sort of treasuries are sort of safer right now. And then gold gets interesting. And then Bitcoin a little later is riskier, but maybe higher upside and those kind of concepts. So that's just a look at smashing that like button right now to help me out with the YouTube algorithm. And yeah, it looks like about only 10% of people actually hit the like button. And that's really what drives the content on YouTube. Um, so, and that's not an asymmetrical 10%. I was just looking at the stats yesterday. And and I wanted to, what is this one? This looks like that looks like a serious bubble correction there. I've been trying to draw these trend lines. What is that? 87? That, this is the Dow. I think that's Black Monday. 87. Let me see. Hold on one second. Let me grab this thing. Yeah. Okay, I think if we grab that guy and come over here, this chart is not inflation adjusted, so this line needs to be curved a little bit. But basically through here, see, I've been trying to make this long-term bull line on my chart, and it's hard to kind of draw it without the inflation adjustment on. But it still should be a pretty good line. But I think right here is a much better spot to start this bull line than, let's see, than where I have had it. And it would be Yeah, kind of through here where it gets all that action. And then we get our dot-com financial crisis. And then you get the steeper bull line that kind of does all this stuff and gets that whole 12-year bull market action. And that's the line that we're testing out right now, is that one. And then you get the steeper one. And each time you crash across the line, you get a steeper one. And then we get this, the Volmageddon bottom. Well, Volmageddon was this first peak, but the whole 2018, I just call Volmageddon because I like the name. And this bottom isn't exactly tied to this Volmageddon peak, but I call this the Volmageddon bottom. And this is the steep one that goes all the way up, the blow off top, and gets our dead cat bounce off the top. But I think Black Monday is a better place to start this long-term trend line than where I've had it. I've been saying the 82 Volcker kind of bottom back here, which is roughly the same, but it's much better to start a steeper up trend line after a bubble correction like this than it is just to pick a random kind of point as the bottom. So let's see. I wonder if I can get another trend line. Like if we go over here, so another point to make, like this kind of stagflation period where it looks flat from about 66 to 82 is not flat at all. Like it looks flat on this chart because it's not inflation adjusted. But if you inflation adjust this, you get this bubble, you get a serious bubble um, that starts in about 66. And this is where the gold like stopped backing the Fed world dollar, and you kind of switch into the euro banking system, and then you get the euro banking system take off here with this 90% symmetry, the asymmetry. So yeah, so I guess in terms of looking at bubbles, if you want to look at asymmetry, basically if you can find the top of a bubble, you have really good asymmetry down. If you can find the bottom at the beginning of a bubble, you have really good asymmetry up, and that's just a general bubble with the entire monetary system. And looking at individual assets is a little more complicated. But I really do like starting this uptrend line from Black Monday, and then I don't think this whole crash is Black Monday. I think Black Monday was just like the little blow off peak here at the top, but this whole correction is a bubble correction that started with Black Monday. And I think that we can get another trend line that's lower off of this Volcker bottom. And this is an inflation adjusted bottom. And then I call it the Volcker because Volcker was the Fed chair here. And he did those two recessions where he was just jacking interest rates up. And it kind of did a noticeable bear market. And people call it the Volcker bear. But it's not really like that little end of the inflation adjusted down bubble doesn't have that much to do with Volcker. Like that's just the last few years of a very long down bubble that started in 66 when we were switching from the gold backed Fed dollar to the kind of the oil backed international banking euro dollar. And this is the euro dollar takeoff, which is the everything bubble is the euro dollar. Um, Sorry, I didn't mean to hijack this video about asymmetry, but I'm on the Dow Jones and this Black Monday popped out on the Dow Jones. So let me just draw some more stuff. Here. Yeah, there should be a bull line that is like this. See, so you get a crossover, right? And then you get a steeper one. So I think we might have a fourth kind of trend line if we use Black Monday that we can run through that less steep market there. I don't know if that works or not. This might actually be more of like an inflation adjusted floor kind of price. I bet if we inflation adjusted that this bottom line would be pretty flat. I think this is an inflation adjusted floor line. I'm gonna make this thing a thing, and I'm gonna make it periwinkle blue because I like that for a floor. And then these yellow lines are the steepening bubble bull market lines. And then you can see on here, every time we get, well, you can't really see with weekly candles, but you get under and back test, you get under it and back test. And then we have one more line here to get under and back test. And this is actually considerably lower bull market line from Black Monday than where I had it drawn before. And that might be a more accurate line. And also that looks a whole lot closer to the Nikkei and the Great Depression with this line. And that I think might be a better line. And then you get the Elliot wave situation. Let me turn the auto off. Let me do a couple Elliot waves. Oh yeah, sorry sorry about this video like going way long. Please hit the like button, and if you're only interested in asymmetry, forget about this. I'll come back and look at this stuff later in some other videos after I have time to think about it. But you get a sneak peek at my upcoming model projections here based on, just a little bump that I noticed. Okay, so this looks like a much better everything bubble starting support line. And then these two are very clear, and we've already back tested both of them, so it's a lot easier to place things in retrospect after you see the back tests and you see where the line is. But I think a really good guess for where this line is here. And I guess I can mention that these are tangent lines. So like right here, the starting point of this line is the beginning of a tangent line, and then you get a waveform along it, and then you get a terminating other end on the tangent line over here when you finish the back test. And so sort of mathematically, as far as tangents go, this termination point on the line is sort of fixed. Like that is where this thing is going to terminate along this tangent line. And I guess if you want to talk about factoring in like the health situation or anything like that, if you look at the Nikkei or the Great Depression, they don't have this deep of a gash downward before you get up and terminate the tangent line. Like the Nikkei was really shallow. It barely broke this line, and then it went sideways and terminated. And then if you look at the Great Depression graph, it broke this thing a little bit deeper, but not this deep, and it went up and it terminated the tangent line. So, okay. So here's a potential update to the model with a lower bottom line. And I've seen on the Great Depression and the Nikkei that this downward move is not tied to the lower line at all. It's usually above it, and in the Nikkei's case, it's way above it. So I've had in my model that these downward moves are close to the lines below, and I think that might just be a special thing with our crash. We're just getting deeper downward moves, and then you get a bigger bounce back because you have to get back up and terminate the tangent. So yeah, I think we might have a kind of a floor valuation on the S&P for kind of unwinding this thing. Well, let's see what it looks like if we use these levels. So we break and backtest this one, and then we break and backtest this one, and then we would break and backtest this one, and probably go out. And they get wider and less steep as you go out in time. And then I guess you could probably get down to kind of something like that, where you probably would be restricted by this kind of mean reverted floor of the bubble. And then usually what happens, like if you look at the Great Depression, you have this kind of mean reverted floor, and you unwind the whole bubble with 3 moves down like this, and then at the end of the Great Depression, you just get like a 2-year kind of swoop underneath the mean reverted line when you get back to it, and that's where the Great Depression ends. And then if you look at the Nikkei, this little swoop underneath the mean reversion line was like 30 years, 20 or 30 years. And it was like a 20-year bear market, and then it came back up, and it's finally now is above the mean reverted line and kind of going up again. But the Nikkei was crazy, crazy long after the bubble unwound. But in both cases, in the Great Depression and the Nikkei, it did this break, back test, terminate the tangent, break, back test, terminate the tangent. So you could bring this one in to where it terminated. And then same thing, you just break it and back test and terminate, and then you can get back to kind of a mean reverted bottom, and then you break the mean reverted bottom and come back. And this time period for going underneath the mean reverted bottom and coming back is extremely hard to estimate based on the models that I've seen, but this one, yeah, okay. So anyways, that's a look at kind of the model and how I draw the lines and what these bull supports are and kind of what the mean reverted bottom is. I don't know if it's just there because this bubble should be above. Yeah, the mean reverted bottom should be below all that bubble activity. Like even below the Black Monday bottom, the mean reverted bottom should be below all that stuff. So I don't know exactly where a mean reverted bottom would be, but I could probably look at an inflation adjusted Dow and kind of get a better. Oh, I remember. I did look at it. I looked at it like 10 videos ago, and it was like 5,000 or something like that. I did a logged inflation adjusted Dow, and it was around 5,000 at the end of the year. I remember that. I had a mean adjusted floor like around 5 somewhere. And then what you usually do is you usually break that thing. All right, so let me draw a couple more lines. Let me do an Elliot wave style also. So I'll do a couple levels of Elliot waves with these lines. And here's your 90% asymmetry down from the top of the bubble, just to pretend like I'm still doing an asymmetry video. All right, so you get ABC corrective Elliot waves on the way down as you're breaking and backtesting these things. So you get the A wave through. That's a terrible line. Get the A wave through, and then the B wave terminates the tangent, and then the C wave down through the next one, right? But this ABC ends up being the A wave on a larger Elliot wave, where you get the A, and then you get the B wave that terminates the tangent, and then you get the C wave down that breaks the next one. And then this ABC ends up just being the A wave of the next level, which is the A here, and then you get your B, which goes over here and terminates the tangent. Pull this thing in. So yeah, I have these tangent lines kind of sticking out on my model, but really when you see them terminate, like that is really the end of a cyclical wave. That it terminates right there, and that's the end of it. And we're not coming back to that thing once this bubble unwinds. Like you just go down, and then so this is the A, B, and then the C would go below where that thing came down to, and then we have this target at our mean adjusted bottom, which was what, around 5 or something on the Dow Jones, and it would just kind of go out wherever. I don't know what the timing is on this, but I think June of 20, I think that's too late. Yeah, I think it would be much earlier. I was having this, I was looking at the cycles and the timing. I had this around the election. That's like October, November-ish, like in here. Let's just go from here. I think that makes sense for the timing. And then you have the inflation adjusted floor, and then you can go down to the inflation adjusted floor on that kind of similar shape. And then that is the end of the bubble. At that point, we have unwound all of the steepening lines on the bubble, and you get three steepening lines. It seems to always be three. The Nikkei and the Great Depression is three, just like this, with the steepening lines, and then it unwinds and backtests all of them. And then you get to a floor, and then you do your like capitulation little swing back to the mean before you get into the next thing. Wow, how long is this video? All right, so if anyone is still watching, that is probably what I'm going to do to update this model now that I've gone on the Dow Jones and seen this Black Monday bubble, and it's a really good spot to start this line. And then, yeah, the Dow Jones is really helpful because prior to this, the Dow Jones really was the stock market, and now the Dow Jones is a little bit less precise for the bubble because the S&P gets all of the activity as sort of the aggregate view of the monetary system. But prior to the .com and everything, the Dow Jones was a really good indicator of the whole stock market. And then kind of from here forward, it's kind of the the Nasdaq bubble here, and then the S&P is just a way better indicator for drawing these models on the bubble. But it works just fine here. It's the same lines, and it's the same whatever. All right. Sorry for another unplanned video, but I think this is kind of a cool one. And it's just, if you're interested in kind of drawing these models or helping me out or whatever, I have, my friend Chris likes playing with these lines and kind of checking my math on things and helping me work on it. So I'm happy for anyone to kind of pitch in and help me work on the bubble models. So there you go. Happy trading.